You heard David talk about the rising price of oil there, so let's dig deeper into that aspect and bring in Nicholas Mulder. He is a professor of economic history, a sanctions expert, and the author of The Economic Weapon, The Rise of Sanctions as a Tool of Modern War. He joins us from Ithaca, New York. And Nicholas, appreciate you taking the time. Thank you.
Thank you for inviting me.
So oil prices are jumping high. They dipped a bit earlier this week, but we're expecting them to go even higher tomorrow. What do you make of this volatility?
Well, I think it's very clear that there is a pretty relentless upward pressure on oil prices that has to do with the largest supply interruption that the Strait of Hormuz and Persian oil exports have ever seen. And there have been a number of attempts to stem it. I think your previous guests already mentioned yesterday the announcement by the G7 countries of a historically large release of 400 million barrels of oil from their strategic reserves. And today an announcement by the Trump administration that they would temporarily suspend the Jones Act. But both of those announcements, interestingly, only very briefly managed to keep the price of oil down, and both yesterday and today it's still closed up. So there's pretty steady upward pressure, and as long as this war continues and the effective blockade of the Strait of Hormuz continues, I don't really see any of that structural pressure disappearing.
You mentioned the Jones Act, the easing of the Jones Act. That's could be like a little piece of this. For people who don't know what that is, just remind us what that is and why that could help.
Yes, of course. So the Jones Act is really only a solution for the United States primarily, but it's an important part of making the internal American energy trade work better. It's a 1920 law that was originally meant to protect the U.S. merchant marine, and it requires that all goods transported between U.S. ports take place on ships that are owned, crewed, and flagged by the United States or by United States citizens. Now, that of course really restricts things today when the United States has a very small merchant marine, only a few hundred ships. So by temporarily suspending it, the hope is, at least the Trump administration hopes, that they can liberalize and increase the efficiency of the internal fuel market, connect the West Coast, Gulf of Mexico, and the Eastern Seaboard, and therefore stem some of the upward pressure. It also is going to help the release of the SPR reserves, most of which are located in Louisiana, so in the Gulf of Mexico.
Mm-hmm. So if tanker traffic through the Strait of Hormuz remains closed, how high could oil prices climb in the weeks or months ahead?
Well, the thing is that no one really knows how high they could climb, but I think it's reasonable to assume that they will keep nudging up by at least a few dollars per barrel a day, potentially, as long as this lasts. And it really is a question of market reaction. In the last week, as this effective blockade really took shape, for a long time, many analysts were very, very surprised by the fact that the market continued to trade as if oil was not really being meaningfully interrupted. I think they're now catching up, and you saw that in the relatively lackluster and indeed even kind of counterproductive effect of these announcements. The fact that the G7 countries announced that they're doing this huge, unprecedentedly large reserve release, in fact, I think made people wake up and made traders realize quite how severe this interruption is. So if this continues until the end of the month, I won't venture any predictions because my main expertise is the study of the past, but I wouldn't be surprised if we see it going past $120 a barrel by the end of the month. And if it lasts longer than that, I see no reason why it couldn't go to 150 and upwards.
Wow, and that would be, I think of it, once it hits 150, that's the highest it's ever gone, right? Very, very high. So one thing that you've pointed out is that the impact goes beyond what people pay at the pump. How do higher oil prices ripple through the broader economy?
So the consumer price that you pay for gasoline at the pump is really only one aspect of it. I would say there's at least two other aspects that are important. We notice the consumer price shooting up very quickly, and that's a phenomenon that economists call rockets and feathers. So the consumer price is extremely quick to shoot up, and then it very slowly floats down over the course of months and even years afterwards. The two other ways that we will notice this shock already are in products markets, so the markets where the things that crude oil is refined into are being sold. And that means kerosene for airlines, it means diesel that truckers and farmers use, it means feedstock for petrochemical plants, naphtha, heavy oil for shipping, basically the real fuel that is being used by a lot of the transport system. That's going to also have a serious effect and raise shipping rates, raise airplane tickets. It's going to raise trucking and freight rates in a variety of ways. And the final effect, and this is perhaps the least understood, but certainly going to be incredibly important for the rest of the world economy, is the effect that this will have on particularly vulnerable aspects of the industrial and food supply chain. Now, helium, for example, is something that is gained from the liquefaction of natural gas, and that is an incredibly important input for chip manufacturing in Asian chip foundries. There's also a very large amount of fertilizer that depends on Persian Gulf gas and oil exports. About a third of the fertilizer in the world, the urea, comes from the Persian Gulf. So all sorts of things that potentially have a really serious effect on global agriculture right as we're getting into planting season.
Now, Trump suggested that the U.S. could lift some oil sanctions until the crisis, quote, straightens out, but he didn't name countries. If he were to remove those restrictions, what impact would that have?
So the administration has already lifted or temporarily given a waiver for Indian refineries to start buying more Russian oil again. They were doing a lot of that before. He could issue further waivers, and Russia seems best positioned to benefit, at least in the short run, from some of those sanctions being lifted, mainly because they had been accumulating a very large floating storage on their shadow fleet tankers, particularly off large Asian ports and refineries. I don't know if there will be other countries where this will be considered too, but certainly in the Russian case, they would have a quite large reserve of at least 120 million barrels still to draw down. Eventually, however, there might be other countries too, like Europe, that would have to at least postpone their prospective and hoped for ban on importing Russian LNG. And Europe's dependence on imported gas is really quite serious. So that is one possibility for sure.
Nicholas, thank you. That's Cornell University professor Nicholas Mulder.